Hey everyone, this is Finance Meets Real Estate. We meet here every Tuesday, 6:30 p.m. Eastern Time. We have amazing guests like our guest here tonight. So we've had over 100 guests at this point on this channel. And so today we're going to talk about Yosef's first deal, actually, that he's already done like way more deals. I believe he's at 11 right now. But we're going to talk about his first deal that he did and how it generated an infinite return. So it's a very, it's a very interesting topic, and like how he's finding, finding opportunities, partnering with others, masterminds, right, and all that. So Yosef is in the New York City area, just like myself. We met actually a couple of weeks ago at their meetup. Okay, so with that, and also litigation attorney, right? Yeah, right, Yosef, as far as
yes, I'm still W2 day
your
job.
profession. Yep. So sounds good. So with that, I'm gonna pass it on to you. I know you have like some presentation slides as well. So if you guys have any questions, feel free to put them on the chat, or I will relate, at the end. So we're gonna have a Q&A at the end as well. So thanks, Yosef. Go ahead.
Okay. All right. So can I share my slide?
Absolutely. Yep.
Okay. There you go. Just a little bit of my background. I am still W2 in New York City. I do personal injury litigation, insurance litigation. That's my day job. At nights and weekends, I become multifamily investor. I started my journey around 2019 by going to biggerpockets.com and listening to the podcast. And 2019 was more of self-education period. And then soon I realized I needed more than just self-educating. So I joined mentorship groups and started my real education, real networking, and took a lot of actions. That was early 2020 where pandemic has just shut down everything, and which was kind of sort of a disguised blessing for me because I had a lot more time to now spend for multifamily and networking. So through 2020, I was able to form my team that I currently work with together. And then by the end of 2020, which was December 2020, I did my first deal. So that's a 44 unit apartment. On the slide, you see here, 2020, 44 unit. That was my very first deal. And in 2021, I did a couple more deals as a co-GP, so 60 unit. That was my first syndication. And then the rest was all syndication. I joined as a co-GP. And then 2022, we did more deals. Out of all, 17 unit was joint venture. The rest was syndication. 20 unit was a joint venture as well. And here it says pending 62, 33, and 40 units under contract. By now, this was an old slide. So by now, we closed 43 unit in November and 40 unit in December. And 60 unit is still in the contract to be closed in a day or two. So this is my real estate background. And today I'm going to, first of all, thank you very much, Stephen, for having me here today. Very excited to share my journey and my first deal. And let's go to my first deal. So the 44 unit apartment is called Crescent Heights apartment. And this is a picture that we literally took my team. I have boots on the ground partner right before closing. So you see those cracks on the parking lots. These are fixed, but this is prior to the acquisition. And there you go. Some more pictures from the property. And this is Google bird's eye view. These 4 buildings are comprising the 44 units. So Lawrence, Kansas. So this property is in Lawrence and Kansas. Let me just move this away. And it's 44 units. And it's all 2 beds and 1 bath. And it was a seller direct off market. Actually, the deal came to my partner through a friend of his who knew the seller. And the seller had an asking price of $2 million. and we had countered with 1.825 million, which was accepted. So the seller had this property for decades, no debt. So he was owning for free of debt, and he wanted to scale up. That's why he was selling, and he really liked our team. The only condition that he had was if we can close this deal in 2020, then he will sell it to us. That was the only condition. And the seller was true mom and pop owner. So my partner went there to get the lease documents for document due diligence, and then we were expecting to get the scan documents, but we were given like a box of physical paper documents. So my partner had to manually scan them in to send it to us. LOI was accepted in September 2020, and we got it on the contract in October.
So Yosef, just quick question actually. So how did you guys find like that market specifically? Like it's kind of a smaller market in Kansas, right? So
The Lawrence?
yeah,
I'm sorry.
right,
What was
right.
the question?
Yeah. How did you guys find that market?
Oh, this market. So, well, it's a Kansas City, about an hour west of Kansas City. So it's not too far away from Kansas City. And just like New York City, we have a secondary markets where people, work in Kansas City, but they also live about an hour or hour and a half away from like a suburb. So, but this specific market, because through my partner who's from Kansas, knew the market, knew the area, and also his friend found this property specifically. So that's how we found this. Right.
Got it.
Okay. All right, a few more deal highlights. So at the time of acquisition, the average rent was about $150 to $200 lower than the surrounding apartments. So we did the comps, and then that's what we found. And average rent at the time of the acquisition was 510. And our underwriting had yearly increase of $50 per each year for units. And the new tenant was already paying 620, so we're comfortable having $150 to $200 rent upside in our business plan. And also there was another exact same shape of the building. So I think the developer in the beginning, they developed 88 units and just cut in half and sold it to two different owners because it's exactly mirror image type of building next to it. And then they were already charging same units for 775 without too much renovation or too much upgrade. So we kind of knew that we have a huge upside there. At the time, it was about over 90% economic and physically occupied. And for the loan, we did 80% loan to cost from the local community bank. And it was a recourse loan. And here's some terms: 4% interest rate, 25 M, 18-month of interest only period. And we had to put reserve for tax and insurance. Just like, it was in the middle of the pandemic, so they had agency lenders and community banks, they all had a reserve, right? And yeah, we had about $250 of rehab reserve raised. As you can tell, this is C-class properties with some deferred maintenance. And we were doing the inspection through due diligence. We found that there are a lot of plumbing issues, mold and mildew and termite. And we complained to the seller. So seller took care of this before closing. But the roof and HVAC system were so old. So we said, either you fix it to the seller or give us the credit from the purchase price. And the seller didn't want to, I guess, work more. So he was like, okay, I'll just give you the credit. So we ended up getting $100,000 credit from the seller. He was asking, like, how much credit you want? And my partner did some research, and then he asked for $100,000. The seller ended up agreeing to that. So the final purchase price was 1.7 25 because of the $100,000 credit. And later, now we did all the roofs and HVAC systems. It costed us about $75,000. So we kind of netted $25,000 from the credit. Okay. At the time, the seller had a property management company, and we ended up inheriting the property management company. So we had a 2-year deal, and there's just one note I want to make. So when I was reviewing the property management company agreement, I was able to find a term where they can terminate the property management agreement anytime they want, within just 30-day notice. But us, the term was in a way that we couldn't do that. There has to be some sort of breach by the property manager, then we can terminate. So when you read property management company, these are sort of things that you need to be careful to find. Otherwise, you're going to be locked in with a contract where you cannot terminate, whereas the other side can terminate anytime they want for any reason, for no reason. So we ended up fixing that. All right. So $60 rent raise was done for just renewing without doing anyone. We just went into the units and told them, if you want to renew, we're going to charge you $60. That was okay. So this was sort of our market testing. All right. So we tested about I think in the beginning, 3 or 4 units. $60 raise was no problem, no pushback at all. And our plan was charging $200 more for second floor after doing new paint and new carpet, and $300 raise for the first floor after new paint and putting some LVPs, and we had to fix some doors. So after fixing renovating the doors, then we're going to charge $300 more. So we tested this, and then we were able to raise $195, I believe, for the second floor, and $250 for first floor. So it was not $300, but something close. So we were to tell that this is doable, this is achievable. And at the time, we had over 50% of month-to-month ratio to yearly lease. That was our business plan, to turn that into yearly lease. And then another business plan we had was, in about 18 months, we were going to cash out refi into agency loan. And keep it for generational wealth, right? That's what we want. All right, so my role was mainly handling the distribution, right? So for the first 6 months, we did not take any money. We just waited until we were comfortable to take our first bite, right? So for 6 months, we did not distribute at all. And then thereafter, we started distributing 8% cash and cash returned. And to start with, and at the end of the 6 month, towards the year end, we distribute more as a bonus. So the cash and cash return for year 2021 became 10% from 8% because the bonus distribution in the end, right? And till we did this cash out refi in April of 2022. So we were holding it about 18 months before cash out refi. And we were able to build about six-figure reserve from pure cash flow. And our month-to-month ratio from 59%, it went down to 5%. And by then we spent about $220,000 capex, fixing things and renovating the units. And average rent went from $510 to $650. So it was about $140 rent bump. And out of 44 unit, by then we just renovated about, I think, about 15 to 20 units. Now we have another 20 something unit to go. So this $140 rent bump, and let's see what kind of magic it does, right? Oh, okay. I want to pinpoint about 3 to 6 delinquent tenants were there, and these were all government voucher. The thing is, their 3 to 6 delinquent tenants the rent will come all together, like 3 months together, 6 months together as a lump sum because it's government voucher. So in the end, it will be filled up, but each time we have to note it as a delinquent tenant. And 2, 3 tenants were evicted, and I was surprised because I'm from New York. I was surprised to see the tenants were being evicted in about 2 months, right? After like there's a 2 weeks notice, and then we just hired a lawyer, and then they were able to evict them in about two months. In New York, that's unheard of, right, Stefan?
Mhm.
We'll take what, a year?
I mean, in New York City, but yeah. Yep. In New Jersey, it used to be 45 days, and now they have some backlog.
Really? Oh, I didn't know. So I guess it's just in New York City where we live.
It's more the city. Yeah, it's more the city. Upstate New York also, like, sometimes can be 45 days, actually. I have done it.
Okay. That's good to
But
know.
but I know what you're saying. It's favorable for sure, what you
Mhm.
guys have.
So we could do the calculation here, forced depreciation, right? So $140 times 40 per unit for 12 months, we were able to force the NOI about $73,000. And ooh, that's the case shouldn't be there. It's about $73,000, right? And if you apply 7% cap, this $73,000 rent bump will add value over $1 million to your property, right? That's how we force the appreciation for multifamily. So at the cash out refi, we did a community bank to agency. We did Freddie Mac this time through CBRE, right? So we signed the contract in February to lock in the rate, and lender appraisal came out to be over $3 million, $3.4 million, because they applied 5.75% cap rate instead of 7 that we thought it would be. So the value almost doubled in about 1 year and a half. And the agency loan was 75% loan to value, 12-month buyout. And it was a little lower than the original interest rate of 3.97%. And after paying off the old debt, the leftover was little over the original capital. So we took out 100% and we had some bonuses. So now what do we have? Anything that we get from cash flow is infinite return because we took out our original capital now. Few of the things I learned from my first deal. So right education is very important. That's critical. We could do a lot of self-education through many different sources. So you got to know what you're dealing with. You need to know how to form the partnership. You need to know how to structure deals. You need to know how to talk to the brokers, etc. However, I think what's more important is to be guided by the people who are more experienced than you are, because just because you know what to do doesn't mean that you're going to be doing well. There are going to be a lot of bumps that you have to hurdle and jump off, right? It can be from anybody that you met from Bigger Pockets or mentorship program, but try to find more experienced people and learn from them. And right partnership was critical. You need to surround yourself with highly motivated people and like-minded people, like my team, and just stay away from negative people. I had many friends who did not understand how multifamily works, and for months I tried to explain this and what I'm trying to do, and I gave up on it because they just didn't get it, and they were very negative. Like, you sure this is something that you can do? Like, it looks like this is not legit. It looks like a pyramid scheme. I had this all kinds of things from my friends. So make sure you deal with people who are motivated, who know the game, and with your interests and business philosophy you're aligned with. Same work ethic is great, and also you got to take massive action, right? I can't emphasize this enough. So you got to literally do it. You got to meet people and network, learn, and you got to underwrite deals. You're going to talk to the brokers, literally call, right? It's not enough to know how to talk to the brokers. It's not enough to know how to structure the deals. You need to do it. You need to pick up the phone and dial and talk to the brokers and the lenders, right? Practice your pitch. And last but not least, by no means, that I fall in love with the process. It's a long process. It took me about 10 months, even after joining these mentorship groups, to close my first deal. So it's a long process. Enjoy it and be persistent, patient, and you see the result. And after I did the first, I believe in the law of first deal. After the first deal, in about 3 months, I closed my second deal. And in about a month or two, I did my third, and so forth and forth. So the first deal is very hard and important. It will take longer. But once you close the first, then you can use that as your credibility and authority. And it'll be easier for you to attract other partners or business partners. Thank you. This is a story about my first deal. And I'll open this up to kind of Q&As if you have any questions, or that I'm here open book.
That was awesome. Awesome. Thanks, Yosef, and great returns on that deal as well, right? In 18 months, like quite a big valuation jump that you guys were able to achieve. So yeah, so do you guys, I just want to open the floor if if anyone has any questions. I guess I'm just going to give it a start with, how did you find your the partners on this first deal, let's say? Is it through the mastermind, Yosef, or other routes?
So I ended up joining two different groups. One group is Jake and Gino, and the other group is MIH Mastermind. I joined these two groups because I saw two different values, and both are paid mastermind and paid mentorship groups. So I joined Jake and Gino. To me, Jake and Gino was more like college, where you could learn a lot, and they have like a hand. They will walk you through the process hands in hand, and you have a lot of networking opportunities. But still, to me, it was like too big to college, and you got to be the driving force to make things happen. Whereas Mastermind is more clustered, smaller, more private. It's like club. And yes, it is also education, but also it's more of action oriented to me. And there's some indirect push by other people. And it kind of helps you for accountability purposes as well. So that's the two different values I saw. So I ended up joining both around the same time, although it's a paid mastermind. And then I met all my partners through that group. I think it was easier for me to become a partner because to me, they are the people who have same alignment of business philosophy. They're the one who thinks joining the mentorship group mastermind is not the cost, but an investment to himself. And also, to me, they were more serious than the people that I met just anywhere else, like a Facebook group or bigger pockets, where we always say, oh, let's be a partner someday, right? And it never happened. But here, people are more serious. They're more direct, and also the fact that they made monetary commitment kind of told me it showed me that they were more serious and wanted to do the deal. So making a partnership became kind of natural within the group. Although you had to meet a lot of people, I had to meet a lot of people. I did about 200 networking calls one-on-one through Zoom in 2020, and then I stopped counting to find the right partner. So I'm not saying you will just automatically meet somebody and become a partner. You gotta do some work there in networking. However, everybody's amazing, and you would have the clear guidelines as to how to find the right partnership.
Mm-hmm. So you did like so many Zoom calls actually back then, even kind of maybe before the masterminds, right? So like, what was your like thought process? Let's say like you, what skill sets, I guess, you were trying to find in those partners so that you guys kind of, link together and, complement each other or so forth? Like, what were you looking for specifically in your partnership?
Yeah, I'll walk you through my thought process was changed. In the beginning, I just joined the group. I was so excited and I wanted to just network, right? So whoever I network with, and I knew I was a newbie. So whoever I network with, my mindset will be like, what can I do for you? Right? Stephen, I know your let's say your GP in 200 units. I'm newbie. I have no experience at all, but I'm very passionate about this. Tell me what to do. What can I do for you? I want to add value to you. Does this sound like the right question? To me, it
Yeah,
was
for
not.
sure. No,
No,
it
it's
was
not. And I tell you
question.
why. Because if you're GP on a 200 unit or so, whatever, and full-time real estate investor, you're busy.
Mhm.
And you just met me on the networking calls and Zoom, and I ask you, what can I do for you when you don't know me? It's a no question. I mean, it could that question could show that I'm passionate, I'm zealous, right? I want to help you. That's great, but you don't know me.
Not
I'm
enough.
giving you another job to figure me out and then to give me what to
Yeah.
do, right?
That's
So after a couple of networking calls, I realized when I asked that question, it's more of work for them. So I changed the
yeah.
question. I changed the frame of the question in a way that this is the things that I can do. This is who I am, and I'm looking for this type of partner. And I want to do this and this and that for you. If you need this help, let me know. Or if you don't, that's fine. Let's just network. And if you know somebody who's looking for somebody like me, please connect me. Right. So that's how my mindset's being shifted from just without knowing clearly, just trying to help, to knowing what I can do clearly, and then
Mhm.
trying to provide that value to
Mhm.
the people who need that value. If the person uh, already has somebody who can add some same value, I don't need to be in his team, right? We don't want to overlap the values, right? So for example, we have 7 or 8 roles in a good syndication team, right? We have a boots in the ground partner, we have capital raiser, we have underwriter, we have deal sourcer, we have investor relationship person, we have somebody who has done a deal before, so that who can provide the experience, right, for acquisition and asset management. We have somebody who has high net worth who could be the KP, right? 7 or 8 roles, give it more so. And it doesn't necessarily mean that you need 7 or 8 partners, right? So 2 or 3, 4 people can take up 1 or 2 roles there, here and there. But what you don't want to happen is you don't want 2 Stefan, 2 Yosef, 2 Scott in the same team,
Mhm.
right? You need to make sure everybody does add value in a way that so that other people can rely on, and you just do what you're good at, what you're best at. And as a team, that's how you maximize the efficiency, right?
Right, right. But actually, so if I may ask you, actually, Yosef, to share like your screen on the slide, like for all the deals that you've taken part of, because it's a lot, right? Do you mind just doing that for a second? If you would just share like the one that has like the sequence of your first slide. Um,
Oh, you made the first slide? Yeah, sure. Hold on,
yeah,
give me 1 second. Sure. This?
right. Yeah. I mean, this is like, it's like 1,000 units of deals participation, right? So how did you manage to do it, to take part in so many deals, basically doing a different deal every month last year? So what was your approach in the previous conversation that you had in terms of like offering value and kind of like pairing with others that have
Mhm.
maybe other skill sets? What was your offer kind of pitch that you had, like that
So my
was
main
so
role.
compelling that you were able to
Mhm.
take part in so many deals? So,
So my main, so I was able to be in this many deals because I'm not doing this alone, right? I have 2 big teams. One first syndication now it's shaped that way. One first it's structured that way. One team I work with together for syndication, that's Sharpline Equity and MIT Realty, and the other team HSI Equity. It's not official name, but I just named it that way. HSI equity that we do JV deals together, right?
Mhm.
And for syndication, I'm just co-GP. I'm not the main driving sponsor. So my role was more limited to helping capital raising and also investor relationship and more of social media promotion. But when I do my joint venture deal, I'm more hands-on because this is more like my deals with my partners. And for joint venture deals, my role is in acquisition stage. I'll become the communication channel. Being an attorney, I'll take up all communications from other attorneys, from seller or buyer attorney, lender attorney, if necessary, SEC attorneys. And then I'll make the communication streamlined for my team members. And also the each stages of due diligence and towards closing, I'll be more of leading force. So if the lenders or title companies and our attorneys, if they need something from our team, will come to me and I will assign to each members of our team so that they could just focus on what they need to provide. And then I'll collect all of them and I'll distribute to them as necessary. So that's my role in asset management, acquisition side. And when it comes to asset management period, I'll be mainly the one in charge of allocation of budgets, managing the bank accounts, making sure how much is for CapEx, tax reserve, and things like that, and distribution itself, how much we can distribute. I'm mainly in charge of that.
Mhm. But that's like in a JV deal, like presumably, like you're saying, you would kind of take part in all those functions that you list, like the kind of asset management, the legal communications, right, and others. But in syndication, like what manages, like just for our audience, like what can help people to get onto the deal? Just essentially capital raising a portion of it. Can you get on that deal if you only said you would offer legal communication?
Okay.
Or
So for same thing, I guess you need to approach in a way that you can add value, right? So let's think about this. Realistically, if you're newbie, you have no credibility. You're not going to be able to just join a team because no one's going to take you, all right? So do the thing, like do the exercise. This is the exercise I did. You will write down these roles, the 7, 8 roles that I mentioned before, and then mark it if you can take that role or not. So for example, in my case, I'm from New York and my market was out of state. Can I be the boots on the ground? No. Then I check no, right? Can I be the capital raiser? Maybe. I'll check maybe. Can I find a deal? Maybe. I checked it. And then can I be the KP? No, because I don't have a high net worth. I checked it. Can I add experience? No, because I never done a deal before. So that role's gone. So if you do that exercise, it will end up for me, only 2 roles were left for me: finding the deal and raising the capital. Now let's again be realistic. Can you just raise capital? No, you can't, because you don't have a deal. So what do you need to do? You need to network and find a good operator and have that operator like you. They have to like you. And then the network, build a relationship, and then to a point where you can actually ask the operator to invite you into the deal because you can raise capital, right? That needs work. You need to build a relationship. Finding the deal as well, you need to build a relationship through networking with the brokers, because just because you ask them for a deal, they're not going to give it to you. You don't have credibility. In this case, what I did, that's where the joining the mastermind came from, right? Because I thought if I join the mastermind, and the network will be more stronger and next level, and if I find the right partners, I can leverage their credibility so that I can also look credible to the brokers and to the people around me, so that that could help me to raise capital more, right? So that was my mindset. That's something that I could tell you to try, because first of all, this is long-term game. It's not going to happen overnight. So constant education and constant networking is what's needed. and joining a mastermind or a mentorship group will definitely help and expedite. But even if you don't, with the proper networking and education and building a relationship, there will be an opportunity. Make sure you always need to leverage off of someone else's credibility in the beginning. So first deal 2 or 3, you don't do it to make money. You do it to build a relationship. You do it to build that credibility, right? And once you build the credibility by going into 1 or 2 deals, even if it's a tiny little percentage, even if it's whatever, you do it. Now you're GP in a deal. That's your credibility. Now you can add different value. Now, and as you are in a deal, don't just become a GP and do nothing. Learn, like see how other main GPs or sponsors are running the deal. Learn from it. Be involved with acquisition process. Even if you don't get anything out of that, just try to learn, right? And use that as credibility. You went through the acquisition process together with the main GP. Now you have some knowledge. Once you're able to utilize your first and second deal as your credibility, like I'm a GP of whatever, 50 units, 100 units. Now, knowing that acquisition process, you can add different value this time. You can add your experience level. You can start nurturing your own team somewhere, right? That's what you should do in the beginning. Just finding a good operator, add value somehow, build a relationship, and being a co-GP. That's how you can start, one way. And if you're in the market and newbie, that's good because you can now work as a boots on the ground for somebody. Now, when you network, your specific target operator should be not only somebody who's in the same market to network with, but also somebody who's out of state who want to branch into the state that you're in and adding value to him as a boots on the ground, right? So be more strategic when you network. You don't just network to meet good people. That's one thing, but you want to network with somebody whom you can add value to, and also somebody who can add value to you. And it has to be reciprocity, right? You can't just do network for the sake of meeting people. So I tell people to do 2 different tiers of networking: one general networking, the other one more strategic networking, more specifically goal oriented to form the team, right?
Right. That makes a lot of sense. And so, question on the chat actually from John is, where can we find C-class properties? I mean, I think they're pretty much all over the country in the US and everywhere, right? So, but
yeah, C-class properties is everywhere.
Yeah,
it's everywhere. The way you can find it is through the brokers or through the property managers doing networking and asking questions. Or you could, I mean, by Googling some, you will have some, famous areas where you can find C-class properties. But that doesn't mean anything to you until you build a relationship with the brokers, so that eventually the goal is to get to be on the list of the pocket list of the broker who could send you the off-market deals, right? That's when you can find this jewel, like the literally good properties. The properties on the market, yes, sometimes they're good properties, but it's already on the market and everybody knows about the deal. So the goal should be, by building the network and by showing that you're credible, to be on the pocket listing of the local broker who could give you the off-market deal.
Right. But in terms of, for you guys, let's say, in which markets you have been able to find, let's say, Class C or other properties? So Kansas City is one, and like, what are some of your other markets?
So Kansas City and Missouri in Kansas, also Oklahoma and Ohio, Cincinnati and Columbus. These are the markets that I'm in.
Got it.
And Vlad right here, there's a Vlad. He is an absolutely A-class, top-notch deal finder. So if you want to know how to find a deal, how to make a cold call, how to have like a direct to seller system, you got to reach out to this guy.
Do you want to tell us about it? What? Yeah.
You're too much. You're too much, Yosef. But I do appreciate it. Not well. I try my best to provide value. And I'm so glad. I actually have a comment that I'm so glad you said it. So people reach out to me and say, "Hey, listen. So how can I provide you value?" And I jokingly say, "Oh, so you're giving me homework now." So I'm so glad when you mentioned, "Hey, listen, it's not what I can do for you, but not what you can do for me, but this is what I can do. These are my skills." So you said it perfectly, and I'm glad you did. So
Yeah, don't waste their time. Like they don't know you. Just don't ask them what to do for you. Just
yeah,
right.
I know
And
what
I
you
get
mean.
now, right. And by now, I get that questions from some young people who reach out to me on social media. I try to be available for them, and I try to walk them through my mindset shift. Like I do this, just the thing that I explained to you. This is the exact exercise I do with them. Right? You got to be this way instead of the way that you approach it to me has to be shifted this way so that you can do more meaningful networking calls, right?
I
But
gotta do
reach
that.
out to Vlad. Is a great guy.
Thank you. Learn from you, man.
Appreciate that, partner. Actually, he found a deal for that 40 units. That lead kind of sort of came from Vlad.
Mhm. So what? So you network with brokers or what?
Who, me?
Yeah. Do you?
No, not really. I really don't. I should
Uh-huh.
speak with brokers more. This particular deal came from off market completely. I called them, and
Oh, yeah.
the guy didn't believe me at first. But I told him, "Hey, listen, you meet with my partner just for 5 minutes," and he was skeptical. So I called my partner, Joe, and I'm like, "Hey, Joe, drive out, meet this guy. There might be a good possibility there." And Joe did, and called the next day, and he goes, "We're buying this thing," and I was just shocked. So we moved quickly. The team was great. Everybody is a solid operator, know what they have to do, and we got this thing closed pretty quickly, I should say. So
Mhm.
and it was very successful.
Well, that's awesome.
The
So,
cold calling is one way to find off-market deals.
yep. So Richard has a question actually on the chat. So he's asking, so did you evaluate alternative option to exchange into a larger asset with fresh upside depreciation and not paying refinance costs on the original property?
So let me so alternate option to exchange into larger assets. Oh, like a 1031?
Sounds like it could be. I think he mentioned, I texted with Richard, I think he mentioned he's not able to speak up right now.
I think that could be an option. But we love the property. There was no reason for us to do that. When we already like the property, we have it. So what we did was we took out 100% and we rolled that money into next deal, right? I invested that money into another 115 unit deal. So yes, you can do that. That's one way, but we just didn't think about 1031ing that deal because we wanted to keep it. We wanted to pass that down onto us. Our plan is for the next 10, 20, 30 years, we just want to keep it. I know after depreciation is gone, then we may think about 1031ing to another property, but until then, it's just cash flowing, right? And we just like that. We love the property.
Right. Yeah, I mean, I think that makes sense, right? I'm guessing, at least to me. But did you guys do a cost segregation also on it, or
We did
no?
cost segregation. Yes.
That's nice. I mean, yeah, that's kind of like cost segregation some people use it instead of having to 1031, right? Because you kind of get the benefits on one property and it's eliminating capital gains. So it's kind of an indirect way a little bit. I mean, that's now reducing year by year, kind of, but starting 2023, but still.
Right.
Okay.
But I think both are powerful way to, just create wealth.
Yep. And so another question from John, actually. So he's asking, so isn't multifamily too crowded and the cap rate too low to make the deal work?
Well, it depends on where you go, right? I mean, cap rate is compressed in a state like Texas. I see, Atlanta, where a lot of people are doing the deals, but there's still states where you could still find the good deals. And just like a 10, 15 years ago, Texas, right? I think, to me, Kansas City is like that, like 10, 15 years ago, Texas, where then it was a great state with cash flow and appreciation together. Now it's becoming more like appreciation play. But to me, Kansas, Missouri, and surrounding Midwest and South is still a good state for cash flow. Yes, everywhere is crowded. You just need to know the market well and the area and the people, and differentiate yourself. Otherwise, where is not crowded, right? At any type of business or everywhere is crowded.
Right. I agree. I mean, there's so many different markets and property, even types and notional levels, even, right? I mean, if you're buying like 2-3 million commercial, it's not too crowded there, I presume. So.
And also, John, Stephen has a great product where you can search all his cap rates and great markets. So you want to reach out to him.
Yeah. The cap rates part, not so much, but thanks, Yosef. Appreciate. And I mean, you're actually quite a bit in the Midwest. So sounds like, were you guys focusing on cash flow? I mean, you're focusing on forced appreciation, really, but was like cash flow something very essential to you, where you do want to make sure you have kind of like a baseline amount of cash flow and only then you force appreciate? Or like what is like, it's like your team? I mean, you have like several different teams, but like some of the thought process there.
To me and to my team as well, because our philosophy aligns together. Cash flow first. But that doesn't mean that we don't want to have an appreciation, right? So forced depreciation essentially comes from having more cash flow because you need to raise the NOI. So raised NOI means more cash flow, higher cash flow. Higher cash flow means forced depreciation. it kind of cycles around. So you can't really think of one thing without the other. But if you have to pick, I'll pick cash flow because to me, appreciation is great, but I want that stability. I want that cushion from cash flow. And I believe cash flow is what could give us the lifestyle, sustainable lifestyle, as opposed to appreciation, where you need to do some transactions, whether you take out the equity from the appreciation, or you need to sell to realize the raised appreciation, right? Which is great, but to me, it's more transactional, right? Whereas cash flow is more constant. Hopefully that makes sense.
Yeah, for sure. I was wondering, Scott, do you have any questions yourself?
Hey, I guess my only question would be, I know on that slide you said going forward, you do have a few deals in the works. One of them you already closed. I'm just wondering how you and all your partners are looking at investing through the rest of this year and coming into next year, since obviously the market is a bit sketchy right now. Interest rates are still up, so that makes it harder to make these deals work. So how are you guys looking at things moving forward?
Great question, Scott. So our year 2023 will be more on operation side, stabilization side, as opposed to acquisition. If there's a great deal, obviously we're not going to just avoid it, right? But the last 2 years, our focus was more on acquisition. And given the market cycle and interest rate and all that, we expect less focus on the acquisition, but more focus on the stabilizing the properties that we acquired for the last 2 years and stabilization. and it will continue throughout 2023. Hopefully, I want to see some light towards the end of 2023 and starting 2024. But our expectation for the almost to the rest of this year will be more just operation.
Now, I'm curious, hopefully this isn't prying too much, but in any of these acquisitions that you did over the past couple of years, do you guys have any terms in any of that debt that say your balloon's coming soon where you'll be forced to refinance at a higher rate?
None of them, none of the deals yet. Yes. Yes.
Awesome.
So we kind of expected this to come because every, we'll say somewhere from 6 to 10 years, that cycle kind of goes around from, expansion, top, and kind of recession and cooling down period. And I mean, no one can predict it, precisely, but we kind of feel, right? So when we acquire the property, we also put a lot of emphasis on getting the right debt. And I learned it from Chris Jackson, who is a just phenomenal leader in that, and who knows the debt, how to get the debt inside out. So we have Chris Jackson on our team who does that, and we're for sure that's the right debt, and that's how we don't have that kind of issues with the deals so far. But I know it's terrible if we have to be forced to refi or sell at a given market with higher interest rate. It would be terrible. But great question,
Yeah.
Scott. Thank you.
No problem. Thanks for the presentation. Congrats on your success.
Appreciate it. Thank you. Thank you.
Just quick addition, if I may. This is where the opportunity for us to buy comes in, where other people's mortgages come due and come, they have to refi thinking, what, 6 now with 2 more hikes coming February and March. They can't refi anymore. They'll be underwater. And that's why when we come in with creative financing, maybe some sort of, master lease option or something like that, and acquire more properties. But yeah.
Great point, Vlad. So someone else's, I don't want to prey on that, but someone else's predicament can be an opportunity for others. And also, wanted to mention this, I kind of forgot, but glad that Vlad, you mentioned that. Yes, when the market is down like this, there are opportunities if you're in the game. So don't be a spectator, right? I want you to be in the game, always underwriting, even if no deals is meeting your criteria. You will find something. And if you don't do anything, nothing's going to happen. So that's something that I want to mention. There will be an opportunity and when market goes back onto the where we were before, like starting from maybe 2024, throughout the 2024, there will be lots of opportunity. So I know a lot of people are saving some dry powders to find that opportunity in 2023, 2024.
Right. And so Johnny's actually mentioning something with regards to rent increases, because we know, as you guys know, like rent growth kind of reversed in some markets, became negative. So what do you think in terms of rent increase is facing pressure? How long can rent increase continue?
So rent increase pressure, I think the term rent increase is kind of relative. So when you buy, so we say buy right, finance right, right? And we say buy right, finance right. So if you buy right, you don't have to worry too much about rent increase, because when we say buy right, we're meaning buy the property that the tenants are paying under market value, under market rent. So if as long as you have some upside and rooms compared to other properties, you can still push. That's what we've been doing. The property we closed in November last year, right? Our rent was about $200 below the market, $150, $200. So if you find this type of property, yes, when you try to push the rent, you will get that pushback from the tenants, right? But they will do their research too. They will go out and try to see if they can move out. Oh, these guys are trying to push the rent up. So I want to move out. And they will soon realize that nearby properties are also charging, if not the same, more than that. And then they'll come back and they'll sign the lease. And we experienced that. So the rent increase, yes, we're being a little more passive than before, but still we're pushing the rent zealously. As far as I know, our team is pushing it.
Yep. Yeah, that makes a lot of sense. I mean, I think that's more for the market appreciation, kind of like rent appreciation going on, but your forced appreciation type of rent, it's still, it's still there. So, and to your point, that's like what's most important, right? To buy the property that has that, has a discount, has forced appreciation, has cash flow as it is, then you should be fine. Anything else you wanted to share with us, actually, Yosef? So it's been great. It's been like absolutely awesome kind of sharing your experience with us. So is there anything we missed, like that I didn't ask you or others didn't ask you perhaps?
Yeah, I'm open book. So if you have any questions, or you just want to network with me, please just reach out to me. I try to be very, very active on social media. My handle is Yosef Yobrosef. So YOSEF, YOURBROSEF. You will find me LinkedIn or Facebook or Insta. Send me a DM. We'll network and I'll answer all questions. I'll share my journey and be friends.
It's awesome. Thanks so much. So those are the best ways to reach you on social media, essentially.
Yes.
Great. Thank you so much. Thanks to everyone as well for joining tonight.
Thank you very much, everyone. Thank you.